Hello and welcome to LiveSquawk's Market Talk. With the earnings season upon us, we thought it time to check in with our market expert for a quick preview of what's to look out for this season. I'll be joined by regular expert Christine Short, Head of Research, Global Corporate Events at Wall Street Horizon, a TMX company. But before we get into the reads, just a quick disclaimer. The content provided on this channel is for informational and educational purposes only. We are not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your own financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. There is a lot to pour over, as I've said, in terms of corporate reporting. US banks will report as of tomorrow. They kick off their section of the earnings quarter, Q2 numbers on Tuesday, with semiconductor firms ASML and TSMC also reporting this week. And it seems that the case at the moment, everything is coloured by the ongoing trade discussions, even if markets aren't as reactive as they probably were back in the first quarter. So, Christine, how are you?
Good morning. I'm great. How are you?
Very well, thank you. Very well. As you may have heard, then we want to get a bit more colour and a bit more understanding of what to expect this earnings season. It isn't the official. It's not the unofficial kicking off with the banks, because we know there've been a couple of earnings out already so far. But generally, people bookmark the banks as the start of the earnings season in earnest, I guess. So,
Right.
yeah, shall we start there, really? What's your impression of the earnings season as a whole and the banks in particular?
Yeah, so right now, FactSet's looking for overall EPS growth for the S&P 500 of around 5%. That would be the lowest growth rate. I think it's 6 quarters, so a little lower than we, anticipated based on difficult year-over-year comparisons. At the beginning of the quarter, I think that was meant to be around 9%, but as you know, analysts always come back in ahead of the season and ratchet down. So likely will be a couple percentage points higher than 5%. But again, driven by tech, and I just think it really highlights resilient corporate performance, particularly in the face of all of the macroeconomic headwinds. You mentioned trade policy. Still have elevated interest rates,
Mm.
and a tad bit of a cooling on the U.S. labor market, the consumer front, and still kind of this environment of uncertainty. So I'd say 5% is really nothing to sneeze at, considering all that's going on. Corporations still seem to be doing quite well. Revenues of 4.2% are what's expected. And then you mentioned, yeah, we do think of the banks as sort of kicking it off, but we've already had 21 companies report. And
Mm.
of those, 71% have beat expectations on the bottom line. And what's more, 81% have beat revenues. And that's been a number that's been pretty light the last few quarters. I think historically, something like 70% of S&P 500 companies beat on revenues, but the last several quarters we've been more like in the 60s. So I'd rather see a better revenue print, right? Because that's a number you
Mm.
can't really manipulate very much. You can do a bunch of different things to get the bottom line higher, cost cutting, buyback shares, all sorts of accounting. But to see revenues beating at a higher level this quarter, and again, it's just the first 21 companies. So I don't know if some of those are bellwethers, but how those go, it's not necessarily how the rest of the S&P 500 goes. But
Okay.
I think it's a great start, right? And then,
Mm.
you mentioned the banks kicking off tomorrow. We've got JP Morgan, Citi, and Wells Fargo. Wednesday, we've got Goldman Sachs, Morgan Stanley, and Bank of America. And that will be very telling. I mean, those do really set the tone, and the executives there set the tone for the rest of the season. They tell us what to expect for the U.S. economy, the health of the U.S. consumer. They will give their comments on tariff and trade policy. They will give their comments on the Fed. So we're about to learn a lot. And I think, you said markets are kind of insensitive right now to the announcements over the weekend on trade policy and potentially 30% tariffs on the EU and Mexico. They're kind of wait and see mode right now, right? So they haven't overly reacted. I think they're about flat this morning. I'm just checking the Dow
Mm.
Jones and the S&P. They are waiting to hear from banks tomorrow and Wednesday, and then I think you'll kind of see markets move a little more based on that information. But I think investors have learned that a lot of these tariff policies have a way of working themselves out to not fret as maybe they did earlier in the year. And
Okay.
companies are kind of getting used to it, right? So they've made moves to, hedge where they have to.
Sure. Just so we discount the tariff issue itself then, and I've seen from your report that people can find online. It's the short list, and it says Q2 2025 earnings preview, modest growth expected amidst economic crosswinds. Looking at the banking sector, you say there are some key figures to watch within the bank reports. We'll start with net interest income. What are you looking for particularly with that?
Yeah, obviously, that's the difference between what banks earn on loans and pay out on deposits. And that has really driven profitability in the last 2 years with rising interest rates. But that's expected to have plateaued. And so don't expect as big of a boost from net interest income this quarter as we've seen really in the last 2 years. The other kind of big thing I'm looking at is investment banking.
Mm,
For the last 2 years, there's been a question mark about when will we start to see signs of life again in IPOs and M&A deal making. And it hasn't really happened. And I think we're just starting to see it crack open in the first half of 2025. A lot of potential, public debuts that were put on the sidelines or delayed last year have finally IPO'd. So you had Circle and Chime and Hinge Health. We are still waiting on Klarna and StubHub. They've both filed, but I haven't seen any dates for when they will officially go public, or if they will. We know Klarna has put it on pause a couple of times,
mm,
but still, it is a great sign and really a bullish sign for how companies are feeling about the environment here in the U.S. I mean, look at it. Also helps that a lot of these IPOs have done really well. Circle up 500% from its IPO price, and that was the situation the last 2 years. It's like if you did IPO, a lot of them were just dismal after they IPO'd. So it made others kind of pump the brakes a little and rethink, do we really want to IPO in this environment? And so you're starting to see that open up. M&A is still a little subdued. We've gotten some mega deals that have really taken up the headlines, like Sycamore Partners buying Walgreens Boots Alliance. That was, I think, for 42 billion. Google's purchase of Wiz for 32. So M&A still a little light on the volume side, but we've had some big deals that have gotten the headlines. And so I'm going to be looking at Goldman Sachs and Morgan Stanley as kind of key bellwethers in this space, because any significant beat on IB revenues would, I guess, signal this broader reopening or this willingness of more companies to make some deals to go public. So that's one area that I think you're going to see be a little brighter than it has last few quarters. Um,
right. So we've covered the banks to a degree. Is there what's the wider picture that you're looking at the moment? And we will come on to what we were sort of talking about beforehand, really, and about the wider economy, the US economy now, and what's happening there. But outside of the banking sector, what are you looking at in particular?
Obviously, I'm looking at tech that's driving expectations this quarter. The names that are more leveraged to AI have had bigger returns this year.
Mhm.
They're overall, though, the bar is pretty low for tech, and I think that is something that played out well for like the Mag 7 in Q1. So again, we know analysts going in there, reacting to corporate guidance, ratcheting down, always way too conservative on all names, but especially these names. And
Mm,
then, when these names end up beating the top bottom line, giving better than expected guidance, investors are very happy. And so this is, a story that played out in Q1. Um, Valuations are still very high, though. So, it's like they have to do pretty well to impress investors. And again, like I said, those more highly leveraged to generative AI, such as Meta, NVIDIA, Broadcom, those are the names that you've seen post some of the higher returns so far this year. And then on
right.
the flip side, it's like you do have some issues with Tesla, obviously, demand there. Apple not doing as well. kind of lackluster product updates. You've got Amazon that's contending a little bit with this consumer weakness we've been seeing.
Mm.
Google search engine, facing a bit of competition with some of these AI platforms. But again, yeah, the kind of four names in that space I'm looking for with updates on AI investing are NVIDIA, Meta, Microsoft, and Broadcom, because all of those year to date are up around 20% or more. So those are the names we're watching, and then we'll see how the other half of the Mag 7 perform. But again, if you aren't investing in AI or you're not showing much progress there, investors, seem not as interested in that. The AI play is definitely back in play here. We saw Micron earlier this season. Their chips in high demand from an AI perspective. That side of their business doing very well. That drove a beat on the top and bottom line. But on the consumer front, chips used for PCs were seeing lower demand, so that dragged a little bit on the results. But so I'll be watching obviously big tech, and then on the other side, the consumer is something we've certainly been watching as the health of the consumer remains soft. I mean, still pretty resilient considering all of the headwinds. But we've already seen from some names this quarter, Nike. Nike kind of has some of their own issues, but they've had to offer some pretty big promotions to get rid of some inventory. They have some competitive things going on as well. Tariffs factoring
Can I just
in
bring on?
there.
Oh, sorry, can I just
Yeah.
raise my hand on the Nike
Yeah.
situation? The fact
Yes.
the fact that they played down their numbers, and people seem comforted by the fact that they played down their numbers and were being realistic about where they were at right now. Is that
Yes.
something people can build on in terms of, do you see now them maybe hopefully starting to ramp that up? I mean, I know we've had trade deals with Vietnam
Yes.
papered, at least, so there is a good sign that there's a bit more certainty from the supply chain, for example.
Yeah, they've been making moves certainly, and they've been moving in the right direction. They've look, this inventory issue has been around a while, and they're finally starting to improve that, even though they did have to offer some pretty deep promotions. But I think that's one issue that's starting to resolve itself.
Okay.
But yeah, again, this revenue miss was mostly due to the softness in North America, kind of mixed results in China. So it's hard when they're offering a premium product here, and a lot of consumers are moving away from. I wouldn't call it higher end. A pair of sneakers is $100, but still, we see a lot of segments of U.S. consumers moving to less discretionary items, right? And so we'll
Right.
see what that means for the second half. I still think the U.S. consumer has been somewhat resilient, but we've seen that trade down, right? Even higher income folks trading down to the discounters, and being
Mm.
a little bit cautious as they figure out what's going on. But I've looked at some analyst expectations, and back to school still seems like it's going to be quite strong. So that's usually when Nike does, pretty well. So we'll see coming into the end of the summer what back to school shopping looks like. But yeah, it was Nike. It was FedEx seeing lower volume, delivery services, lower volume, especially for their more premium express service. That all, they're not delivering as many packages because people aren't ordering as much. And so
Mm.
you're seeing kind of that weakness creep into every segment, with the exception of, Delta already reported. And they really have been a bit of a roller coaster story coming into this year. CEO Ed Bastian said, "Oh, this is going to be a record year for revenues." And then, not a couple months later, going into the Q1 earnings season, they actually did, in between reports, gave lower guidance, which doesn't always happen, right? Like usually you wait
Mm.
till you report to give guidance, but they wanted to warn investors that demand wasn't quite there. And now we have Q2 results out. Oh, summer travel demand has been very robust, especially for premium, priced products like the, business class and premium, economy seats and whatnot, and transatlantic flights as well. So it just goes back to this story that cropped up after COVID, where people are willing to spend on travel and experiences, and maybe are moving away from apparel and things of that nature. So we've gotten like a bit of a mixed picture on the consumer, but it's something I'm always interested in, not just when, retail earnings come out, but in some of these other areas like travel and logistics. And, we've already, like you said, gotten results from Nike, but It will be interesting to see how that picture evolves in the second half of the year, because we have our two biggest sort of spending periods coming up with back to school and then holiday shopping.
Well, like you say, consumers are still prioritizing experiences and travel over goods. So it goes to what you just said. If we go on to, I mean, you touched on Amazon as well, and the underperformance of the Amazon sort of summer sale. Do you see that then being reflected in some of the other consumer, like you say, we'll wait and see. But has there been any kind of ripple effect on from that? Uh, is lackluster too strong a word for the Amazon sort of discounting that we've seen, the sales window that we've had?
Yeah, so yeah, Amazon Prime usually, you see a bunch of other retailers take advantage of that, right, by offering their own
Mm,
sales. So it's become this own mini, twice a year, July and October, you tend to see retail sales pick up around the time that they put that on, because everyone else is trying to match it. So you're right. I
mm.
mean, we'll see. That always ends up being like a record, and they've expanded it, from 1 day to now 3 days, twice a year. So that ends up working quite well for them. And I'm sure when they report, I think in 2 weeks, that's the sentiment that we'll hear. But again, it will all be about forward looking guidance. We don't so much care what happened, in Q2, but it's about what's going to happen in the second half of the year. And can they continue with that momentum into their October event, into their, end of year holiday shopping? Um, they tend to be one of the winners because you can get a variety of pricing on there, but really they're still competing with Walmart. Has been kind of the take all winner of this softer consumer environment.
Right.
Partially because of the grocery aspect. They have such a large, and what is it, 60% of their revenues is their grocery business. It might be even more. In the fact that you can go and do your grocery shopping, and hey, while you're there, you might pick up a few discretionary items that you wouldn't have otherwise. I think that's really what helps drive Walmart as well, in comparison to Amazon.
Okay, cool. Talking of forecasting and everything else, the last sort of week or so, we've had Goldman Sachs and Bank of America upgrade their S&P 500 estimates. What's your opinion of this? Do you agree with them? Do you think that they're overdoing things at the moment and overly enthusiastic about the US equity markets at the moment? What's your view? I know that Bank of America has said they forecast that S&P 500 index is likely to reach 6,300 by the end of the year, with potential to grow to 6,600 over the next 12 months. I've got that dates wrong, haven't I?
Yeah, I think that was
Yeah,
2024, but
that
you're
was
right,
2024.
6,600 by the end of 2025. And same, Goldman Sachs was 6,600. That's about a 5-6% increase from where we are now, which I think is absolutely possible with 6 months in the year left, two earnings seasons, the potential for the Fed to cut rates in September, December, which is currently what the CME Fed Group uh,
Yeah,
FedWatch tool is predicting, two cuts, 50 basis points total, and earnings that are expected to come in, like I said, 5% this quarter, which will certainly be higher because most companies will beat. The Q3 expectation is for 7%. And I think by end of year, overall calendar year 2025 earnings growth is just slightly in the double digits, around 10%. So I think if all of these things come in, if you get those rate cuts, if you have earnings come in better than expected, which they always do, I don't think a 5% increase from where we are now is crazy to believe. But again, we've discussed this, but I think the markets are sort of discounting some of the trade policy talk. So I don't know. I'm not so worried about that right now. It's going to be in the numbers. Earnings growth has been the main driver of stock market returns since the
mm.
end of the great financial crisis. So if those come in where they are expected to today, I don't see any reason the S&P 500 can't hit 6,600 by the end of the year.
Well, it would be fantastic, really, considering the headwinds at the start of the year and what everyone was fearing. We tend to get the case where nothing is quite as bad as it seems, and even if it is, it's an opportunity to buy the dips or whatever it would seem over the last few years. What we've seen for the equity markets out there, from what I've read, no one's expecting that to change in terms of reaction function in the near term, at least.
Yeah, because the underlying picture is still strong, right?
Mm,
I mean, like I said, there's a few pieces that have softened, the labor market, the consumer, some GDP forecasts have been all over the place, but overall, historically speaking, the labor market's quite strong here. That's really the backbone of everything. If everyone feels comfortable that they will have a job in the next 12 months, or that if they lost it, they could easily get another one, then they keep spending, right? And we've seen that. Consumer spending is 70% of this economy, right? 70% of US GDP. So
mm,
if the jobs picture, the labor market stays as strong as it has, I mean, unemployment at pretty much at full employment, or still at historical lows despite a slight uptick here and there. Jobless claims haven't really been anything to worry about. So I think if that all stays intact, it makes sense. A lot of the things markets traded on and the uncertainty in the beginning of the year were news related, policy related, things that didn't come to fruition. And everyone's kind of getting back to the fundamentals now in the overall picture, which isn't, too shabby. So I think things will continue. We've kind of learned from the first half of the year, even corporations, we collect data on earnings dates and whether companies are delaying them or pulling them forward. And delaying earnings dates is sort of a sign of corporate uncertainty, right? Like if you push your date back, you're
mm.
like have potentially bad news to share, and you're kind of trying to figure out how you're going to share that. And heading into the beginning of the year, into the election, even for the third quarter earnings season of last year, we were seeing companies very uncertain and pushing their dates off. And last quarter, we saw them kind of, moderate a little bit. So it showed us that U.S. corporations, they've kind of figured it out. There's not as much maybe to worry about, or they've figured out how to hedge or do what they have to do to kind of work with these headwinds.
Sure. Just, I wanted, it's a bit of a curveball for you, but in terms of this moving away from US assets, and this is a more global picture, we're taking ourselves out of the North American picture so much. Have you seen any shift towards European assets away from US dollar denominated assets from your perspective, from what you can see? We know that obviously you say that, and it's been said that the equity markets themselves are still looking fairly robust. But have you seen any evidence of that anywhere in your research?
Yeah, I mean, yeah, I am mostly US focused, but we did see earlier in the year, certainly this pivot into what we call rest of world stocks as, investors were kind of looking for a safe haven or
Mm,
unsure of what would happen here. But then with some of the trade policy, because that impacts everyone negatively, it was like, where do we go? Okay, we go to gold. So it was like,
mm,
who's sort of safe. But now, obviously, look, the S&P is only like a 0.5% off its highs, even with some of the latest tariff news. So it seems like there's been this return. We also see, look at Bitcoin is on fire. So what does that sort of say about the whole picture? I mean, they hit over $120,000, which a few years ago, if you told me that, and I think there were analysts that said it would go above 100,000. I said there's no way, and all of that has happened. So yeah, I mean, investors are looking outside, but I think there's been this return to U.S. equity, the the TINA trade, as they call it. There is no alternative because that is where the growth has been, and with tech on fire
yeah.
as it has, and maybe not as impacted by Chinese competition, which is still a worry. But we've still, again, I named a few companies there that have still seen year-to-date returns of 20% despite those April lows. So I do think there has been a turn back, more so than, yeah, at the beginning of the year, we did see investors looking outside of the US because they weren't quite sure what was going to happen. And now the picture seemed to moderate a bit.
So the story is solid growth for the Q2, looking for decent forecasts into Q3 and the second half of this year, and really until we get more, I guess, certainty on the tariffs, and by certainty, just conclusion to some of these trade talks. Everyone's fairly happy with the way things are positioned right now.
I'd say so.
Would that
Yeah,
be
I
it?
mean,
Yeah.
absolutely. It was like almost a worst case scenario heading into the year with the uncertainty, but I think everyone's kind of figured it out. And at 5% EPS growth, that's a healthy number, expected to be higher, expected to end the last 2 quarters of the year with high single-digit growth. GDP's come back up. I think the Federal Reserve Bank of Atlanta is now at 2.6%. That had been all over the place. S&P is very close to its all-time high. So markets are working well. And like I said, the underlying picture, the labor, the resiliency of the U.S. consumer, who, yes, is taking a bit of a breather, but still active, still there. I mean, that's one area we talked a little bit about banks that I'm looking at is credit quality. And yes, there's been higher delinquencies on credit card payments, but nowhere near historical highs. So we're still sort of seem in a safe place with that, even though things are cooling a bit. So yeah, I'd say going into the second half of the year, it's not all coming up roses, but it's certainly better than I think where we started.
Yeah, and listen, the Fed doesn't seem to be overly concerned by it either. I mean, we've had comments from Powell of late and from other officials that maybe question like you say, the rate path of whether we get 1 or 2 further cuts into the second half this year. But ultimately, they're quite happy with the current pace and state of the US economy as a whole in the labor market. So again, if they're not seeing any red flags anywhere, it's full steam ahead, I guess.
Absolutely. Yeah. Sometimes the commentary can still be a little cautious, but I think it's gotten less cautious as we've gone on. And like you said, it doesn't seem like any urgency to cut rates. And so that's sort of a good sign on the strength of the US economy. And, maybe it keeps getting pushed back. It was meant to be the July 30th meeting. That's where the analysts were expecting, but even that doesn't seem likely. I think 95% probability that there will be no rate cut on the July 30th meeting in a couple weeks here, and that it's been pushed back to really the third or the fourth quarter, the third and fourth quarter, September, December meeting. So that's all very bullish that they're not seeing any immediate signs or need to lower rates.
Okay, well, with that, let's finish on a high note. And I'd like to thank you. Well, it's good that we can finish on a high note, considering what we've had so far this year. Look towards the Q3 and hopefully further upgrades to forecast, really. And we'll see. But so we're recording this on Monday, 14th of July, ahead of Tuesday's bank earnings from some of the big hitters. So we shall see what they have to say about the Q3 and beyond. Thank you, Christine, for coming on to today's episode. Always much appreciated.
Yeah, thanks so much for having me. Always a pleasure to chat.
Oh, brilliant. Thank you. And guys, we'll put this out there on the socials and on the platform, and you can pick it up in the usual places. Thank you for listening, everyone.